Hello and welcome to our conversation on accounting. In this session, we will understand the impact of business decisions on the accounting equation and the financial statements, namely the income statement, receipts and payment, that is a cash flow statement, and the balance sheet. So we would like to examine the impact of incomes, expenses, receipts, payments, assets, liability, and equity on the accounting equation and on the financial statements. And let us do that with an example. Suppose these are the set of transactions or the business decisions. First, we will try to convert this into accounting equation. Then we'll convert that into these transactions into financial statements and compare the accounting equation with the financial statements. So ABC started a company by contributing 300,000. We know that accounting equation is S is equal to A. And in the first transaction, is the money contributed by the shareholders or the owners as capital, and the business has received money 300,000. So therefore, at this point of time, the company's equation will look like this. Cash is equal to capital. So A is equal to S. Purchase designer garments for cash. So cash will reduce to the extent of 200,000, but a new asset, which is stock, will appear because the company has purchased the stock from the market by using the existing cash. No change in the capital, okay? The existing cash was used. Now, but for this much stock which is there, 40% of the stock was sold for 450 for cash. That means the cash will increase to the extent of 450 and the stock will reduce. Stock will reduce to the extent of 40%. So the stock will be now 200,000 minus 40%, that is 80,000. The stock will reduce by 80,000. And no change in the capital because no infusion of money, no withdrawal of money. But if you observe, there is a profit here. Okay, and the profit is equal to the cost minus, or the sales minus the cost. Okay, the sales is 450 and minus the cost of goods sold is 80,000. So therefore profit is. At this juncture, we are assuming that entire profit has been retained by the company in the business. Then paid salary is to X. So because you paid salary, the cash goes down. No change in the stock, no change in the capital, but since salary is an expense, salary will reduce the profit. Profit is equal to income minus the expenses minus the cost of goods sold. Now, the next one is rent due but not paid. Because of accrual, we have to create a liability, and that liability is called rent payable, and the rent payable is 150,000. But because of this expense recognition, profit will reduce to the extent of the rent payable, and we show the rent payable because of accrual concept and the matching concept. Doesn't matter whether you paid or not, profit is equal to income minus the corresponding expenses. No change in the capital, no change in the capital, no change in cash, no change in stock. Now, the last one, the company uses the services of Mr. J for advertising and issued shares in consideration of that. Did not pay cash, not even committed that they'll pay later, but they immediately compensated Mr. J by issuing shares. So as a result, the shares will increase to the extent of the service received. Okay, to the extent of the service received, the profit will reduce because we have paid expense, and this expense is the advertisement expense. Is so profit will reduce by 100,000 because advertisement is an expense for that period. No change in the rent payable, no change in the cash, no change in the stock. So therefore, you can see that every transaction will have an effect on the accounting equation. Now you need to examine whether the effect will impact the profit or cash or any other items. So by the end of this period, the company has a profit of 20,000, ignoring interest, interest and the taxes. Now, if we convert the same transactions into financial statement, you'll get the same profit, okay? Determination of profit. The determination of profit will happen by preparing the financial statements too, okay? So let us prepare, hide the accounting equation and unhide the, let us prepare the financial statement. The financial statements will show this balance sheet, income statement, and cash flow statement. Balance sheet, income statement, and cash flow. So we'll examine the effect of each item on the on these financial statements. So the first transaction is the raising of capital, and the company received money. It's a receipt, and the company received money to the extent of 300,000. Okay, it's a 300,000, and the receipt is not an income but a part of the source. They purchased garments for 200,000 and paid cash. So therefore, there is a payment for 200,000 for purchase of garments. And the garments is an asset at this juncture. Okay? The garments are the assets because they have not been yet sold. And 40% of the goods have been sold now. So there is a sales of 450,000. And this entire sales is for cash. So therefore, there is a receipt to the extent of 450,000. And whenever, because we know that of matching concept to determine profit, we need to show the corresponding cost of goods sold. And the corresponding cost of goods sold is 40% of the stock. So as a result, stock will reduce to the extent of the goods sold. Okay, stock has come down to the extent of, stock was 200,000, stock has come down. So COGS, as I mentioned here, is an expense because the benefit expired. But the stock is an asset because that will have the ability to generate future cash flows. Now rent, so salary paid, okay? So the salary to the employees is an expense and salary has been paid. And salary is an expense. So it's a payment and expense. Whereas the rent due but not paid is an expense, but we did not pay the rent. So therefore, it will appear on the balance sheet as a liability. Expense not paid is a liability, and And if expense is paid, there's a reduction of cash. The third expense, that is advertisement, the third expense, which is advertisement, we have not paid cash, not to be payable also, but an asset, the shares have been issued to the extent of 100,000. So increase in equity because of. So one expense have been paid immediately, the rent is to be payable later, advertisement is an expense, but no payment now, but immediately they have been given the shares of the company. So all the items have been transferred to the financial statements. Let us find the profit. Profit is equal to incomes minus expenses. So profit in this case is 20,000. Okay, profit in this case is 20,000. Income 450 and expenses for 30. So profit is equal to 20,000. If no information is given, we'll transfer the profit and retain that on the balance sheet as a source. So the entire profit is transferred to the balance sheet. Now let us prepare the complete the cash flow statement by deriving cash in hand. So cash in hand is equal to cash available. Cash in hand is equal to cash available, which is 750, minus the cash payment, which is 300,000. So cash available in hand is 450,000, which is an asset. So if you see this, the balance sheet depends on the income statement and cash flow statement. The profit, if retained, is transferred to the balance sheet as a source. Cash is an asset, will be transferred to the balance sheet as an asset. Now, since all items are taken care, if the sources should be equal to the sources, balance sheet should tally. Okay, so therefore we can see here the sources are 570 and assets are 570. And what is the source consists of? Equity 420, liabilities is equal to rent payable. So sources A is equal to E plus L. A is equal to E plus L. Observe this profit and examine that. Compare it with the equation. So in the equation also, we had profit 20,000. But the difference between the equation and the statements are, the equation will not be in a position to tell us how did you get that profit. But in the income statement, we'll know all incomes, we'll know all expenses. Therefore, income is equal to income minus expenses is equal to profit. In the same way, on the equation on the last day shows cash 450,000. But how did this cash come? Where did this cash come from? Why did the cash change? These questions cannot be answered by the accounting equation unless you observe line by line every equation. Whereas a cash flow statement will tell us all receipts, all payments. So receipts minus payments is equal to cash in hand. And the balance sheet will show the financial position as on a particular date. So this balance sheet will show assets on a particular date, which is 31st March year, is supported by the corresponding sources, and the sources are capital, retained profit, and other liabilities. On other word, the sources are equity and liability. So whether we prepare through equation or through the financial statement, we end up getting the same profit. Since normally we don't get the opportunity to see the equations, so all that the companies do is to share their financial statement. So observe the effect of the business decisions on the financial statement. See how the balance sheet, cash flow statement, and income statement change with the change in the decisions. Or examine the impact of the decisions on the financial statements. Okay, thank you very much.